As far as China is concerned, it's clear that China does not want to rock the boat. China does not want to poke the American eagle, as it were, being responsible or partly responsible for the collapse of the dollar. So while China has made contingency plans against that event, she's going to await developments, I think, before she takes a move to protect her own currency. And when she does, it's almost certain that she will also put her currency onto a gold standard. Basically, what it does is it undermines the use value of the dollar, not for US domestic purposes, but internationally. And we should bear in mind that according to the US Treasury tick figures, foreigners own, in total, roughly $32 trillion and dollar-denominated financial assets. So they won't need to hold on to that quantity of dollars. So you can see that there will be selling of dollars. Now, the problem for the sellers is, what do they buy instead? Do they go and buy another currency? Well, I've just sort of enumerated the problems of the other central banks in the major currencies. The answer to that is no. So, if they come out of the dollar, they either go into something like the Chinese yuan, or they go into gold. I think this is one reason why central banks, who have seen this coming, have been increasing their gold reserves substantially for the last 2.5 years. And that is a process which will continue. And the fascinating thing about this is, let's look at Singapore. I mean, it's rather like a canary in the coal mine. Singapore has bought enormous quantities of gold for such a small island. I mean, I can't remember. I think the population is something like 9 million or something, which is not vast. But, she's got substantial gold reserves now. Now, why is she doing this? She's doing this because Singapore is run by a Chinese diaspora. They know what's going on in China. They understand the mindset. They understand the politics of China and the whole of Asia. They can see the Shanghai Cooperation Organization business for what it is, and they know that they're in a wonderful position to really benefit from this. So what are they doing? They're setting up effectively. Not only are they setting up to protect their own currency from the demise of the dollar, which inevitably will follow, and of course all the other dependent currencies, but also they will probably become the non-Chinese regional center for gold trading. I think they plan to go in that direction. It's fascinating because silver really is entirely an industrial metal. I mean, if it was being priced as money, then the gold-silver ratio would be back to where it was at the time of Sir Isaac Newton or whatever. I mean, we'd be looking around about 15 times, something of that order. As it is, it's 78 times, so it's not priced as money at all. But the fascinating thing is that when gold rises, it rises twice as fast, or nearly twice as fast on average. The problem is that when gold stops rising, it tends to fall. But then it's very much a manipulated market. I reckon the Chinese have controlled the price very effectively for some considerable time. But they're losing that control now because the Indians are coming in with industrial demand big time to offset their carbon footprint with coal-fired power stations and all the rest of it. The government policy has been to support, subsidize, encourage large industrials in India to produce photovoltaic cells. And Reliance Industries, which is one of the big conglomerates, opened its first 5 gigawatt production facility in March. Now, I reckon that a lot of the standing for delivery that's been going on on COMEX has actually been Reliance Industries and its competitors, because where else do they get the silver? It's just not there. It's taken out elsewhere. I mean, I think we're looking at the third or fourth year of a deficit of supply compared with demand, and so the liquidity's gone from the market. And I think so. What I can see is that the price of silver will go considerably higher as this trend continues, without considering monetary factors at all. But if you look at the traditional relationship between gold and silver in the market, then market operators, I think, will tend to move the two in tandem because they've always done it that way.
The global financial landscape is changing, with doubts growing over the US dollar's dominance. Foreign entities hold $32 trillion in dollar assets, but as confidence wanes, many are turning to gold. China is carefully planning, increasing its gold reserves while avoiding actions that could destabilize the dollar. Singapore is a notable example, significantly boosting its gold reserves. As a financial hub influenced by the Chinese diaspora, it aims to protect its currency and become a regional gold trading center. Silver, with its dual role as an industrial and monetary asset, is also gaining traction. The gold-to-silver ratio, currently at 78:1, suggests silver is undervalued. Demand for silver, particularly in renewable energy, is rising, driving prices higher. China and India are major players in this shift, increasing their gold and silver holdings to hedge against the dollar's decline. China's careful strategy and India's industrial demand for silver indicate a move toward more resilient and stable assets as the global economy evolves.
I mean, there are senior Russians who do understand the benefits of putting the currency on a gold standard. I mean, I'll give you an example as to why it really would be very, very good for Russia. At the moment, the central bank's deposit rate is 16%, and that's what's needed to stabilize the ruble. If the ruble went on to a gold standard, then practically for Russian banks, for example, Chinese banks, other banks, it would make sense for them to buy gold in the West, where the yield is 2%, sell it to the Central Bank of Russia in return for rubles, which linked to gold is a gold substitute, and they're picking up 14% on the way. What's not to like?
Yeah.
That is actually the way in which you manage a gold standard. You don't use interest rates to try and manage the economy. You use interest rates to manage your gold reserves. And that was learned the hard way in the wake of the 1844 Bank Charter Act in the UK, because it failed something like 3 times before they actually realized that you don't use interest rates to try and manage an economic outcome or to manage the banking system. What you do is use it to exclusively manage your gold reserves, and then you don't have a problem. So on that basis, it's very easy for Russia to stabilize her situation. And just think of the benefits. Interest rates would then decline. Russians in business would find that they can, if you like, their business calculations become a lot more profitable. It means that they will be able to cut the cost of their output and all the rest of it. It would be like another industrial revolution. I mean, it would be fantastic for Russia. And it would actually get her away from having to rely on the export of commodities in order to have a surplus on A, her balance of trade, and B, on her budget. The situation in Russia is that taxes, if you look at personal income tax, it's around about 13%. The higher rate is 15%. I mean, these are levels we dream of. Corporation tax is 25%, admittedly. The government debt to GDP is, and this is despite the war and all the financing of the battles against Ukraine, debt to GDP is only 21 or 22%. So you can see that actually Russia is in an amazing situation, and she can easily go onto a gold standard. And she has been pushing for this. She wanted to get gold, a gold-backed currency onto the agenda at the last BRICS meeting, but it was turned down by China and India. India does not want to upset the West. India is not in a position, really, to consider a gold standard because she's been in denial about gold for God knows how long. She's tried to stop her citizens from buying it. It's only recently that she started increasing her gold reserves once she realized the geopolitical situation she was in. As far as China is concerned, it's clear that China does not want to rock the boat. China does not want to poke the American eagle, as it were, being responsible or partly responsible for the collapse of the dollar. So while China has made contingency plans against that event. She's going to await developments, I think, before she takes a move to protect her own currency. And when she does, it's almost certain that she will also put her currency onto a gold standard.
Senior Russians understand the benefits of a gold standard for their currency. Currently, Russia's central bank has a 16% deposit rate to stabilize the ruble. If the ruble were gold-backed, Russian and Chinese banks could buy gold in the West at 2% yield, sell it to Russia's central bank for rubles linked to gold, and earn 14% profit. This method uses interest rates to manage gold reserves rather than the economy. Stabilizing Russia's economy with a gold standard would lower interest rates, making businesses more profitable and reducing production costs, akin to an industrial revolution. This could lessen reliance on commodity exports. Russia's taxes are relatively low, and its government debt to GDP is around 21–22%. Russia has proposed a gold-backed currency at BRICS meetings, but China and India have declined. India avoids gold due to long-standing policies, and China fears destabilizing the dollar. There are accusations that COMEX and LBMA manipulate silver prices through futures contracts, keeping prices low despite rising physical demand, especially in green technologies. This could lead to a price correction. With central banks increasing gold reserves and silver's dual role as an industrial and monetary asset, a shift in the global financial landscape is likely. As the dollar's dominance wanes, precious metals could play a more central role in the global economy, leading to a new era of monetary stability and growth centered around gold and silver. The financial landscape is unpredictable. Investors should diversify into precious metals like gold and silver. Understanding the geopolitical and economic factors driving these changes can provide valuable insights for future investments and policies. Staying informed and adaptable is crucial for financial stability and growth.